Good afternoon and welcome to HYROX's weekly webinar where we are going to talk about what we see happening in the global economy and financial markets and the world of wealth management and how all of this impacts our decisions on the best courses of action for our and your investment strategies. We invest our money in the exact same models as our clients, and we think that this is really important, that we are eating our own cooking. Our discretionary management enables us to make quick decisions and execute them immediately for all of our clients simultaneously, which is especially important in volatile markets as we take advantage of opportunities that avail themselves to us. I'm Scott Tomlinson, and I'm joined by my partner and colleague Paul Tepsich, the founder of HYROX, who has done some great bottom-up research for our tactical model and has been quite astute with a few of his value picks so far this year. He'll talk about those or some of those a little bit later in the show, but they have been continuing to add value to our models and portfolios while at the same time reducing our exposure to risk. Our financial planner and wealth forecast specialist, Bianca Tomlinson, is also on the call. We will have a question and answer period at the end of the call, so if anyone on the call has a question about any aspect of how we manage wealth, we invite you to feel free to ask those questions. We are recording this webinar so that those who can't join us live can tune in when it is more convenient. If you are a first-time listener and would like a little more information about our private client services and our disciplined investing strategy, we have a separate introductory webinar that will provide you with this on our website under the Private Client Division tab. Well, each week we quickly recap our themes for 2016, so before we get started on what happened last week, let's review. As I have mentioned pretty much now every week for the last 9 months, our overriding theme for 2016 is that financial markets will remain volatile, and we expect that to increase as we get closer to the U.S. election. Now, we think that the risk of a recession in the U.S. is high and rising. Low inflation and deflationary pressures continue on a global scale despite the efforts of central banks to mitigate them. An extraordinarily stimulative central bank monetary policy on its own has not succeeded in reigniting economic growth, and now central banks are revisiting their options. The U.S. Federal Reserve wants to raise rates, but can they? We don't think so. And there is also now talk of the European Central Bank beginning to taper its bond buying program. The rise of populism in developed nations, and now with the U.S. presidential election, there is a concerted pushback against globalization and freer trade. Throw in the terrorist threat, racial tensions, and the sum of it all is having an impact on consumer, business, and investor psychology. The bond markets have concluded that central bank policies are suggesting higher concern for the global economy. Yields dropped last week, but they have risen again this week, and certainly part of that comes on the back of some better economic data, but also the potential for the European Central Bank to begin tapering their quantitative easing. We think equity market prices do not truly reflect the underlying fundamentals, and possibly there will be a 6th consecutive quarter of negative annualized earnings growth as we get into the earnings for the 3rd quarter. And we are in a time when the risk-free rate of return is basically at 0%. Some might even say it's negative. Well, inflation, depending on your circumstances, is at or about 2%. So the math suggests that to get better than inflation and growth with your money, you need to take risk. The question is how much and what kind of risk. We think that investors are taking on far too much risk relative to their potential returns. Well, let's have a look at what's been driving markets over the last week. Volatility has slipped over the last week, but as we head into October, move toward the U.S. election and the next Fed meeting, we think that volatility will probably pick up. And with higher uncertainty will come more fear. Again, the Fear and Greed Index is about where it was at this time last week, but we do think there will be more fear to come as we move forward. Well, since our last webinar, our benchmark World Equity Index is lower by about 0.5% and up by about 5% on the year. The UK FTSE 100 index was the best performer. The S&P 500 index was the worst performer. The Canadian TSX has been the best performing country index in the developed world this year. China's Shanghai Composite has been the worst performing index this year. The Broad and Diversified Benchmark Equity Index, which we gauge the performance of our global equity model performance, covers close to 2,500 companies domiciled in 23 developed countries and 23 developing countries, and covers 10 economic sectors. As a result, we watch closely how the key component countries' economies are evolving. However, it is also important to remember that many of these companies have a global perspective, so we also need to keep in mind that it is the companies that we are investing in, not necessarily the countries. September 30th was quarter end. Our benchmark All Country World Index was up by a little under 5% since the end of June. Year to date, the benchmark index is up about 7.25%. Over the last year, up about 10.30. Over 3 years, up about 5.5%, and then over the last 5 years, up about 11.8%. If we combine the equity and bond indices into a balanced scenario and allow for fees and MER costs, the total return for a 60% equity and 40% bond index combination year to date is 5.5%, or just slightly under. The 1 year is about 7.25%. The 3 year about 4.35. The 5 year 7.5. And the if you take a slightly less risky balanced portfolio of 40% equity and 60% fixed income, the year-to-date performance is just a little under 5%, 6.38 for 1 year, 4.40 for 3 years, and just a little under 6% for 5 years. By comparison, a client who started with us in January and has a 60-40 balanced portfolio has a total return this year to date after fees and costs of about 7.10. That's nicely ahead of that benchmark, which comes in at 5.44. So interestingly, our defensive strategy, which has a lower exposure than the benchmark to the equity market, but it has better returns, proving that our strategy is providing excellent risk-adjusted returns to our portfolios. The after fees and costs 1 year performance of a 60-40 HIROC client is 7.95 compared to the benchmark at 7.29, and the longer term 4 year plus annualized total return since inception is about just a little over 8% versus the benchmark, which is incorrect because that is the incorrect calculation. So I will have to put my head together for that one for next week. I must also remind all of our listeners that, as I do each week, historical returns are in no way a guarantee of future returns, although at HIROC we work very hard to try to get the very best possible risk-adjusted returns for our clients and ourselves at all times. Well, fixed income prices were lower, led by U.S. bond indices this week. In the world of commodities, oil was higher, gold was lower, and with a possible agreement for OPEC oil production coming in November, oil resumed its uptrend from its February lows, and the Bloomberg Commodity Index is once again trending higher. Well, the U.S. represents more than 20% of the global economy, and with over 50% of the companies in our benchmark index domiciled in the U.S., we do keep a close eye on what's happening there. Almost 70% of the U.S. economy dependent on the consumer. It is obviously important for the consumer to be quite confident. Now, when consumers are uncertain, they will postpone spending decisions. When businesses are uncertain, they will postpone investing decisions. This makes it a tough environment for economic growth, which in turn also makes it difficult for corporate earnings to grow. Well, the U.S. presidential election is one of those factors causing lots of uncertainty and will likely cause more as we approach Election Day on Tuesday, November the 8th. For the moment, Clinton continues to hold a slight edge over Trump, and this follows the week that the media described as Trump's worst week, which included the debate and his subsequent tweets and comments. Nonetheless, with the vice presidential debate tonight and debate number 2 between the presidential candidates on the weekend. There is still over a month to go, and plenty can happen in that time. Now, if you haven't seen it, I highly recommend the Saturday Night Live debate sketch. Alex Baldwin nailed the Trump character very well. Well, in their decision and press release 2 weeks ago, the Fed suggested they expected economic activity to expand at a moderate pace and that the case for an interest rate increase had strengthened. Yesterday, Fed Vice Chairman William Dudley acknowledged that some economists are concerned that the risk of recession is increasing. At the same time, voting member Loretta Mester suggested that the case for a rate increase was compelling in November. This all comes after the Fed reduced their expectations for economic growth once again for 2016, as well as increased their expectations for unemployment following their September meeting. So, again, it's difficult to determine exactly what it is that the Fed wants to do. We know they want to normalize interest rates, but on the other side, we don't know that the U.S. economy is strong enough to withstand an interest rate increase. So we wait. Meanwhile, third quarter GDP estimates continue to decline as the consumer has pulled back on spending and non-residential investment has also declined. In its most recent update to its World Economic Outlook, the International Monetary Fund, the IMF, marked down its forecast for the United States this year to 1.6% from 2.2%, following a disappointing first half caused by weak business investment and diminishing pace of stockpiles of goods. Elsewhere in the global economy, the International Monetary Fund maintained its forecast for weak global growth today and warned that further stagnation will fuel more populist sentiment against trade and immigration that would stifle activity, productivity, and innovation. The IMF said that a drop in U.S. growth for 2016 due to a weak first half performance would be offset by strengthening in Japan, Germany, Russia, India, and some other emerging markets. The fund kept its overall global growth forecast unchanged at 3.1% for 2016 and 3.4% for 2017 after cutting its outlook for 5 straight quarters. Taken as a whole, the world economy has moved sideways, said IMF chief economist Maurice Obstfeld. Well, Brexit is certainly a symbol of the rise of protectionism. On the weekend, Prime Minister May set a March date to begin exiting the EU and said full access to the country's largest trading partner was a lower priority than controlling immigration. And the pound has fallen as a result to lows not seen since 1985 against the U.S. dollar. Uncertainty following the Brexit referendum in June will take a toll on the confidence of investors. UK growth is predicted to slow to 1.8% this year and to 1.1% in 2017, down from 2.2% last year. The euro area will expand 1.7% this year and 1.5% next year compared with 2% growth in 2015. And the Canadian economy is expected to grow at 1.2% this year and jump up to 1.9% in 2017. In China, policymakers will continue to shift the economy away from its reliance on investment and industry toward consumption and services, a policy that is expected to slow growth in the short term while building the foundations for a more sustainable long-term expansion. Still, China's government should take steps to rein in credit that is increasing at a dangerous pace and cut off support to unviable state-owned enterprises accepting the associated slower GDP growth, said the IMF. China's economy, the world's second largest, is forecast to expand 6.6% this year and 6.2% in 2017, down from growth of 6.9% last year. Well, where do we see all of this taking us? Bond markets lead other financial markets. Let's see what bond markets are suggesting. In the U.S., bond yields were higher and the yield curve steepened, partly as a result of some slight improvements to manufacturing data, but also certainly as a result of expectations that the Fed may increase rates in December, as well as the European Central Bank will start to taper their quantitative easing program. Higher yield and a slightly steeper curve followed in Canada, and the improving economic data over the course of the week pushed UK rates higher as well as steepened curve there. The Euro-German curve also steepened, negative yields moving back closer to the 12-year and under maturities. There was an increase in inflation data over the course of the week, as well as the ECB's news about quantitative easing and tapering. The Japanese yield curve flattened slightly with somewhat higher unemployment data. Well, as for equity market value, and as we continue to stress, the fundamentals for stocks do not look good. This year alone, earnings growth for the year has been revised from an expected rate of growth of 6% at the beginning of the year to a negative 0.2% at this particular time. However, S&P 500 stock prices have risen by about 5%. Third quarter earnings are expected to continue the negative growth for a 6th consecutive quarter. As the bottom-up earnings per share estimate declined by about 3% during the quarter, the value of the S&P 500 increased during the same time frame. From June 30th through September 30th, the value of the index increased by about 3%. Now, the third quarter will mark the 16th time in the past 20 quarters in which the bottom-up EPS estimate decreased during the quarter, while the value of the index increased during the quarter. Again, for us, this looks like shares are expensive. But why are earnings important? Well, because they are the fundamental reason for buying stocks. When investors buy stocks, they buy a stream of future earnings, which go to pay dividends or reinvested in the company. Now, the price to earnings ratio represents one of the metrics to measure stock prices relative to earnings. The 10-year average price earnings ratio is 14.3 times. The 12-month forward price to earnings ratio, which incorporates analyst forecasts for future earnings, is currently at 16.6 times. That difference is what makes stocks expensive. We would prefer to buy equity assets when they represent reasonable value at or better than the long-term averages. And stocks and bond correlations have been moving in sync. Paul, do you want to talk a little bit about this?
Sure. Thanks, Scott. So I think we mentioned this last week, but it's good to have a graph up, even though it's a bit busy. But what this shows us is the white line in the top half is the S&P 500, and the yellow line in the top half is the U.S. 10-year bond in yield. And this goes back over about 5 years. And the bottom half of the graph is really the correlation study that I did. And as you can see in the far right, when it drops down and becomes, the shaded area is red, when the blue line drops down and into the red, it shows a very high, or what we call it, tight correlation between the U.S. 10-year Treasury and the S&P 500. And this is more of an anomaly. This is not what is supposed to happen. In fact, I had a meeting this morning with another asset management firm, and we were talking about the ability of government bonds, be they U.S. Treasuries or Government of Canada bonds, and specifically in 10-year and 30-year bonds, to provide a natural hedge to other risk assets in a portfolio, like equities, other corporate bonds, high-yield bonds. And in fact, this is no longer working. So that's why we sold out of some of our 10 and 30-year bonds a few weeks ago when we saw this correlation start to break down, and they were no longer performing the way they were. So we will, until this correlation starts moving the other way, we are not going to be adding more longer dated government paper. So it's something we're certainly keeping an eye on. And to see where it's been over the past, you'd have to go back to early 2007 and then to 1999 to see it this tight, or this tight a correlation between bonds and stocks.
Now, back in 2013, that was when the Fed began to taper its quantitative easing policy, correct?
That is correct.
And then, so do you expect that if the European Central Bank tapering does happen, that this may also be somewhat of a lengthier correlation situation?
It certainly looks like it today. Government bonds got absolutely hammered today on some rumors. Whether the rumors or not, we're not sure, but the ECB may, in fact, start tapering their quantitative easing program a little bit earlier than anticipated. So, yeah, that could happen.
So normal theory behind a balanced portfolio would have bonds and stocks negatively correlated, so that's where you would end up getting the balance. When you start to get these situations occurring, you're all of a sudden you're out of this balance, right? So it is an important strategy to be able to be somewhat nimble with how we're structuring our balanced portfolios. Is that right?
Yeah, absolutely. Good point.
Okay, excellent. Thank you for that, Paul. That's just another reason why we have discretionary management, so that when we see these things happening, we can take advantage of the fact that we can simultaneously buy and or sell assets that we need to for our clients. It makes us very nimble.
Well, we can operate, like you said, in a heartbeat, but we also need to have that experience and knowledge to recognize that this is happening on the screen here.
Absolutely, and it's a non-discretionary advisor, A, may not have the experience, but B, also couldn't do it for their clients because they would have to make the call to the client first. Okay, thank you, Paul. I'm going to get you to come back in just a second, though, and talk a little bit about our tactical model. But before we do that, I'll just talk about what I talk about every week, and that is that we still are cautious and defensive. I was on BNN explaining it a little bit yesterday for those of you who may have been able to see that. But again, it does not mean that we're not investing, but we're just utilizing our skill set to ensure that our client portfolios are invested to achieve the best possible risk-adjusted returns using the best and what we would think would be the optimal strategies for each of our individual models. It is clear that we've been able to not only capture growth, but keep it in times of higher volatility. So part of our success this year, not only with being nimble in fixed income, but also we've had some interesting situations occur in our tactical model that have been favorable. Paul, did you want to talk about what went on this week?
Yeah, well, the week's only 2 days old, but yesterday was a very good and interesting day for us. And I wrote a blog on it this morning, but we had not one but two of our portfolio companies, two of our investments, see takeover bids on them. So the first one was Conexus, where we own the stock. We own about half of the stock we used to own because we sold some stock and bought more convertible bonds, and then 2 weeks ago we bought a pretty good weight, probably our biggest weight in most people's portfolios outside of government bonds, in a senior unsecured high-yield bond that Conexus issued. And there are very specific reasons for doing that, but as people may recall, it's trading across the entire capital structure of the company, from the senior unsecured bonds right down to the stock. I don't think there's a lot left in the stock. I'm pretty involved in this situation. So that's part of the reason why we've been selling out of some stock, but we have our real play is in these convertible bonds, which we bought around 90 cents on the dollar, and they will get taken out at par, which is called a poison put or a change of control when the company is purchased. And the senior unsecured bonds we bought at par just 2 weeks ago are now 106.5 bid. So a 6.5% return over 2 weeks on a high yield bond is spectacular. And I don't think they'll go a ton higher, but as the bid works through, we're going to continue to collect a 7 5/8 coupon on this bond. So it's a great trade. I'm very happy with the way this has played out. We may get a tiny bit more in the stock, but it's for all intents and purposes played out. The second company that we had, which was a complete and utter surprise, was Direct Cash, which is a company we owned a very, very small amount of stock for the last, I'm going to say even 6 months or more. And it paid a very stout dividend. They do a lot of cash flow analysis on it. And I ended up buying some stock just last week, or 2 weeks ago, just because I wanted to start layering some in with the expectation that it's a really good dividend-paying stock, and it'd been hit down pretty hard. The company is about 25% owned by the founder, and I did not think he would sell, but he clearly did yesterday. He engaged with a large U.S. competitor called Cardtronics. They ended up coming in and showing a $19 bid on the stock. It was trading at around $12.85, which is where we bought stock 2 weeks ago. So we had a 45% return on that over about a 2-week period. And we didn't have a huge weight in it, but every little bit helps. When you have a stock that's taken out at a roughly 50% premium, you don't have to own a lot to add a little bit of incremental value to your overall portfolio. Away from those two takeover candidates, we did do a bit more selling. We sold out of 2 specific stocks and sold right out of them as of this morning. I paired out the last of one, and we did actually buy a bit more of another stock and its underlying high-yield bond. And again, the high-yield bond goes in the tactical model. And that company, we already own some stock in it, but I've been searching for this bond for a while. I was able to find some with a friend of mine, and we split the trade. This company I'm talking about is going to be very similar to the Conexus trade, where these bonds are trading at a deep discount to par being 100 cents on the dollar. And I think this company is going to get taken over. And we bought these bonds around 86.5 cents on the dollar. If the company gets taken over, these bonds get taken out at 101 minimum. So, and I think we'll start putting a bit of pressure on the company to engage with a buyer. So that's, I think that kind of is a good summary of what's been going on in tactical for now, Scott.
Yeah, that's great, Paul. You've done a spectacular job. So thank you for all your hard work there.
You are welcome, and so is everybody.
All right, few things coming this week. We're going to see the U.S. non-manufacturing PMI. Earlier in the week, we saw the U.S. Manufacturing PMI, which is up a little bit more than expected. So tomorrow we see non-manufacturing. Of course, tomorrow is our HIROC client event. We look forward to seeing our clients and their friends tomorrow evening. Then Thursday is the U.S. G20 finance ministers and central bank governors meeting, and of course they'll be talking about world situations at that. Then the IMF World Bank annual meetings, again probably talking about global trade and those kind of things, and hopefully continuing to work towards a freer trade global situation and then not the opposite. On Friday we'll have Canadian and U.S. unemployment data. U.S. unemployment data certainly is going to be key for Fed decision making in their November meeting and likely their December meeting, so we'll keep a close eye on what's happening there. On Tuesday next week, again, we'll be back for our client webinar. Then we'll start to see some data out of China on Wednesday and Thursday, trade and inflation, and then a look at what happened over the course of September as far as U.S. retail sales, get another gauge on the consumer who has not been spending money recently. And again, a reminder, tomorrow night, 7 to 9 at 206 Bloor Street West. We look forward to seeing our clients and their guests, and I think it will be a lovely evening, so looking forward to you all being there. Well, that's it for today's discussion. If there are any questions, I'm sorry, we are out of our regular time. So what I'm going to do is just say, along with those listening to the recorded version, if you have a question, please feel free to email them. We'll also certainly appreciate any feedback we get on these calls. And of course, we're always available to have a phone call directly with any client. So you know, we have our numbers up there. You're more than welcome to give us a call if there is a question that you wanted to deal with specifically. Okay, well, thanks all for tuning in and taking that time out of your busy schedule. And don't forget to tune back in next week. But until then, this is Scott Tomlinson signing off.